The Moodle and Miller has proposed a theorem of market value independent of its capital structure. And they were discussing about the capital structure. So, as per this theorem, uh, the value of firm in a market is not related with its capital structure. When I trade in shares, my major interest is not how much debt or equity is there. My basic interest is to see that how much the benefit I'm getting and how much returns I'm generating. So the Moodle and Miller approach of capital structure state that the perfect market of firm's value or the overall cost of capital remain unchanged if the debt to equity mix is unchanged. So as per them, what is a combination of debt? What is a combination of equity? How we measure it, how we format it, it will decide how the capital structure will be. He has the first proposition, which talks about that the value of firm is equal to the value of equity plus debt. So I have equity or I have debt. We're just seen in Excel. When there's a tax absent, the firm value will be solely determined by the investment decision and cash flow. The first proposition what he has made is the perfect capital market, equal browsing rates, perfect information, and no taxes. So this was the formula which he proposed as first equation. The first proposition he has proposed is introduction of tax in 1963. The proposition one that value of firm is defined by the value of equity and the combinations. So the first proposition he discussed that there is no tax. He discussed this proposition in 1963. As per this proposition, when the corporate tax are introduced, the irrelevance theorem are changed because interest payments are tax deductible. Using the debt creates a tax shield and that increases the overall return of the firm. The total value of firm will become higher than the unlevered firm. Now, levered and unlevered, these are two components which he has used. If you go to previous discussions, here he talk about the first proposition. He says A levered firm is equal to unlevered firm. Now, any guesses what is meaning of levered firm? The levered firms talks about the own capital plus debt, whereas unlevered firm talks about only equity. So if I have borrowed capital, it is combination of own plus borrowed. It is called as levered firm. Levered firm means the firm which has a charge, the firm which has income. Whereas unlevered firm is that firm which may not have borrowed capital or debt capital. So even though the value of two things or two propositions will be same. So he has first considered that the firms, even though have equity or debt or only equity, their value remains same. Their decisions when is going to change, how they are, what their combination, it is important to ignore. What he says, total pie doesn't change regardless how you slice between debt and equity. So the first proposition of MM is the value of firm is not going to change if your equity or a debt. So let me again explain this proposition. Please remember there are three propositions of Moodle and Miller. Out of that, the first is if I have capital structure, it is divided into debt and equity, or if I have capital structure which is only equity, they are equal. How I divide my capital? Suppose instead of this, if my debt to equity ratio is something like this, that debt is more, equity is less, or anyhow, it will not going to affect my the value of firm. The value of firm will talks about how I'm managing my returns, how I'm managing my incomes, but the value will remain unchanged if the own capital or borrowed capital they have any combinations. So he used the word a total pie doesn't change the size of slice, sorry, regardless how I slice is at debt or equity. So the first thing he used is cost of capital, that is cost of equity plus cost of debt. So the formula he used is this. Yesterday I discussed this with using Excel. Hope you remember. Let me share the Excel sheet so that you can recall it. So initially we have the explanation about the first things, and then we work out and find out the value of firm. So he has talked about the value of firm in this fashion using the formula. As per him, The value which was previously said to be 90 because of interest and debt calculation is just we are talking about how the things are worked out. But now, if I calculate using the first proposition, that is KE, that is the cost of capital plus cost of equity minus cost of debt divided by equity, I'll find out the value of firm is high or less, regardless any combination. It is only depend upon how much I am paying to my debt. So this was the calculation part we done yesterday. Hope you able to recall it. So here the debt to equity ratio will be a key indicator. The proportion of debt to equity will be a key indicator to understand the capital. The cake can be sliced anyhow, but what is the cost of debt? What is the cost of capital? This is going to make effect on overall value of firm. So the first thing he has proposed is this proposition. Sorry, second proposition. The first proposition which we calculated is which is equal to VU into T into D. He has added the tax. Let me just reshare the Excel sheet where we have calculated the value by using the same way. We added the tax, we have find out the C. So we're done with the proposition 1 and proposition 2. Now, the MM, he always talks about no tax. The further financial scientists, they study these propositions and they has evaluated the this proposition onto two lapses. One is a tax and second is WACC. Why the tax is important? Because in first proposition of MM, he talks about the tax existence, and in second proposition, he ignores the something called as a tax. So in both the propositions, we have find out the WSCC and tax is an alteration is done. In the first case, if you can notice here, the equation is remains same. Only the part of modification happens to be 1 minus tax. Normally, tax is given 10%. So, if I want to find the tax 10%, there are different ways. So, people, instead of multiplying as percent, I can write 10% as 0.10. Or when the tax is something, the other way is suppose 1 minus 10, 0.10, I can find out the value of firm as 0.90. So that the reason here 1 minus t is introduced. Let me start the calculator and share the screen again so that it is clear to your side. I hope the calculator is shown. Suppose 1 into 10% means 1 divided by 10, sorry, 1 into 10 divided by 100. My answer is 0.10. So this is one way to propose it. In MM approach, what we intend to do is 1 minus zero point 0.1. What I get value is 0.9. Suppose my value is 100 and I have to find out tax-free value. First, I need to apply the 10% tax. So I need it into 10 divided by 100. My tax will be 10. So 100 minus 10, my answer will be 90. So this is a long way. So what we do is 1 minus tax rate, that is 0.10, my value will be 0.9. Now what is my cost of capital? 100. So my answer is exactly 90. And that's why they multiply 1 minus t as the proposition value. Otherwise, the formula remains same. So we have the three propositions. The first one is, sorry, the first one is d divided by e. Second one is the value is divided by value of firm into tax into the debt. So he first proposed the tax on debt, and secondly, we have the modification in third level where the tax is modified with WSCC and with original formulas. So these are the three equations of MM approach. Please just go through the equations. Please remember, this is the most important theory as per your syllabus is concerned. So you cannot keep this theory as an option for your syllabus. Let's continue further. The real world consideration beyond this MM is something called as the trade-off theories, and this is a working. Now we have already done the working, so I'll take a pause of few seconds and we'll move to the other theories. Just read this numerical. Now When you talk about the numerical, we are just applying the first proposition, that is unlevered and levered firm. In first proposition, when it's unlevered, don't have debt, then value of firm is the EBIT divided by cost of capital. My value is 2,50,000. And when I consider that with equity capital, I have the debt, then my value is decided by 2,50,000 into zero point 0.5. Why zero point 0.5? Because 1 minus 50% tax, the answer is 0.5. Into debt, then value becomes 3 lakhs. So it is my 1 lakh, sorry, it is my equity capital or borrowed capital. Simply, the increase in 50,000 is value because of tax shield created using debt finance. So if I want to say the contribution of the is basically talking about how to maximize the shareholders' value. He is the person who evaded that instead of just thinking what is the debt and what is the capital, we should think about the unique combination of debt and capital. We should talk about the market structure and the interest rates. The combination of rate of interest, the market structure, will definitely make an effect how we are dealing. The theorem decides the benchmark how the capital structure can affect value of firm. So whether I should have borrowed capital, own capital, how much dividend I'm paying, how much dividend I'm collecting. So he has proposed that instead of just understanding value, we should think about the wealth maximization of shareholders, and that will be the optimum capital structure. They also won the Nobel Award for their contribution in corporate finance. So this theory of is most important. Now that's all about theory. Any doubt in theory? Now let's talk about the second theory of capital structure, that is trade-off theory. Sorry, I'll not share the screen. So let's talk about the trade-off theory of capital structure. Before that, I want all of you to take a pause of few seconds, and if any doubt, you can just update me in chat box. So, no doubts, let's continue the most important, the trade-off theory. Why taken a pause? Because when I switch from MM theory to trade-off, there is a confusion about the propositions and thinking. The MM was advocate for wealth maximization. So, according to him, giving only dividend is not the welfare. How I can retain and maximize this dividend for a longer period so that instead of a single source, the multiple source of earnings are available will decide the capital structure. So when you talk about the Moodle Miller, it is basically importance is given regarding three propositions. One is the value, second is equity, third is debt. Regardless, it is modified with WACC and tax. So the combination is not important, but how much return I'm generating, that will create the trust in mindset of users, and that will help the investors to take a decision about the theory. The trade-off theory is a theory which talks about the risk and future of mix of debt and equity. So it is theory which talks about balancing between debt and equity. It is not saying that debt is good or equity is good. Like MN, it says both are good, but one should balance between the debt and equity. The trade-off theory is basically making choice about the terms, making choice about how the firm will act and what is the combination of debt and equity. Every firm is faced a fundamental condition that what should be their source of finance, whether I should go with the debt, that is borrowed funds, or whether I should go with the own funds. Now, when I decide to go with borrowed funds or own funds, I'm certainly talking about the advantage and disadvantage of both. When I just analyze the growth of any firm, the growth always happens to be with reason. The growth always happens to be a reason where we are always being dealing and understanding. There is a glitch. I'll stop the share. Let me work out on the file. Okay. Let me reshare the file. There's some error occur. Yes, I guess the file is visible. Yeah. So in the confusion, which, where, and how, there are some advantage, there are some disadvantage. If I have control and I want total money to be retained, I don't want somebody to share my profits, somebody to share my success, or somebody to share my efforts. I prefer equity financing. In equity financing, more and more risk sharing is feasible and the profits are retained with the organizations. The priorities or lendings are less. In case of equity finance, it is not mandatory to provide the interest or dividend, even the loss is made. So, as per this condition, the equity capitals, when they are dealing, we have advantage that they are risk free, their own capital, and they have the benefit regarding understanding the financial part. The best part about equity is if I have profit, I'll give the dividend. If I don't have profit, I'll not give dividend. If I want to increase the capital, issue the bonus shares, I can issue the right share, I can do the stock split. So I have the advantage of control, I have advantage of regulation, I have advantage of managing the risk when I'm equity capital. But when I go with the borrowed capital, that is debt capital, I have advantage that my risk is shared and this shared risk will help me to mitigate the arise expenses. This will help me for understanding the risk so that if there is a profit, my equity share will get it, but little portion. So earlier they are getting 100 rupees. Now the contribution is 70 because 30 is shared by the others. But considering all this, the risk is shared. There is no impact on ownership and the bankruptcy or financial distress is welcome, but the obligations of paying interest and distress can be set off by thinking of the medium term or shortfall of long term applications. So when I take a borrowed capital, then in this borrowed capital, a long term obligation is not there, long term ownership is not there. They are just interested for their duration and the interest term. So, what approach I'm thinking about, a long term, medium, or how? That is certainly very important when I'm talking about the concept. In case I was just thinking that for time being, I need the adjustments. Time being, I just want to explore the available opportunities and benefits. So in that case, I can have debt, but When I'm making a thought of long run, I normally prefer equity. So if I'm interested for short run, go with the debts. If I want to intend to go for long run, then instead of debt, I'll go with the equity. If I want ownership sharing, I will go with the debt. If I want non-ownership sharing, I'll go with the equity. So what is my purpose and for what reason I'm using? That certainly will talk about the purpose and benefits what I'm going to share. So it is just dealing of the combination which is intended either ownership or a burden, and that is nothing but a trade-off theory. So in trade-off theory, I have to talk about the combination of both and impact of both on my firm's investment policy. This theory is having foundation of MM approach. They have taken the extension of MM approach. As per this theory, the growth or change in the firm is welcome, but this change is a consideration of understanding the major foundation of MM, that capital structure is irrelevant for firm's value. So in reality, the application of corporate tax, application of debt, application of interest will certainly make impact. For example, if I have to pay dividend, the rate of dividend is 16%. I have short-term loans, I have to pay around 18%. Then these value propositions or borrowed will certainly make an effect on my capital structure. And this is not being justified by MM. He proposed that tax shield is irrelevant in value. But when I call about the perfect combination of capital, these things need to be valued. So the trade-off theory, it talks about the financial distress, tax shield, and information asset. So it says interest on debt is tax deductible, reducing in effective tax burden, increase the firm's value. So the first thing it has proposed is effective tax burden. Whatever the debt I'm having, for example, I can have my own capital of, sorry, total capital is 100. If total capital is 100, out of which how much debt I can have? I have two types. One is debt and second is own capital. So what is the ratio of these two? The ratio should be depend on certain factors. So the first factor is interest. Second factor is a tax. Third factor is inflation. And these three factors will decide how much debt I can use. If I find these three factors are positive for equity, then the proportion which I first decide of 100 rupees is debt is 10 and equity is 90, because these things are positive for equity. If they are not positive for equity, they are average, then I will switch 100 rupees as 50-50, 60-40, or any combination. I'll take it 50-50. But if these things are positive for debt, then certainly I'll take 100 rupees and the combination will be 100. So out of 100, 90 will be borrowed capital and 10 will be equity capital. So how these three things making impact over the overall cost of firm, I need to make a thought. So the tax benefit, the legal charges, and the information available, they will be calculated for understanding capital structure. In simple terms, if I want to say, if somebody gives me 100 rupees, there is a tax of 20 rupees, there is legal fee of 10 rupees, and there is a commission of 10 rupees. So what is the amount I'm getting? I'm just getting a 60 rupees. So I'm collecting 100, but actually I'm getting 60 because these are the burdens I'm carrying. So if these burdens are higher for debt, go to the equity. If these burdens are higher for equity, switch for the debts. And for both own capital and borrowed capital, if these burdens are there, then I have to take decision of 60-40, 50-50, 70-30 as per my convenience and source available. The basic trade-off theory says when the firm is managing its financial assets, it should think about direct and indirect costs. It should try to manage the direct and indirect cost in such a way that they will create an asymmetric situation or equation which will lead to financial obligations and understanding how the finance is move about. So just give me, I'll just edit the slide. It is not readable condition. I'm just changing the font size. Unfortunately, it is so small that nobody can read it. So a firm will decide its risk in such a way that whatever the benefits which are generated, they are being applied or they are utilized in simple proportion to their value. So when we are analyzing the equity or debt, we should always talk about the value or the benefit which arises. So while financing the business, I need to think about two risks. One is the financial risk and a business risk. There are two levels. The business risk talks about industry and operations, and financial risk talks about the interest and legal obligations of debt. So whether equity is there or debt is there, both are most welcome. So Moodle and Miller both are scholars. The traditional approach, yes, it is also accepted. But what is more relevant to me that the risk and returns they are evaluated and calculated in such a way that the risk and profiling is managed more effectively. So when I talk about these two people, the two trade-offs, the advocates that a firm's value or its profiling will be of such nature that it should create an positive impact considering the values associated, considering the risk associated. So I choose equity or I choose borrowed capital. The risk and the return should be equated. To visualize, when I have the low cost of leverage, that is, if the debts are having low interest rates, I can borrow maximum. I reduce my own capital. If they are equal, that is, my borrowed capital and own capital cost is equal, then I can have the average break-even formulas for the same. In case the borrowed capital required higher interest rates, then I had to think that debt should be less and equity capital should be maximized. So while analyzing the firm's value, creativity, growth, one should be precisely clear and understood that borrowing cost and legality is the combination I should think about. It is my own capital or it is my borrowed capital. So here it is graphically shown that return on investment or return on equity is the most important thing which is important. If I borrow a debt and it generates more returns, accept the borrowed. If the debt is creating less return for the equity holders, don't take the debt. So the profits of my firm, which I earn, is distributed between own capital and borrowed capital in a such a way that the returns should be maximizing the owner's equity. If returns are impacting owner's equity and it will create a financial disturbances and not giving any benefits, simply go with own equity capital. If I can share the financial distress, share the financial obligation, and borrowed capital is risk free, then go with the risk free. So, as per this theory, the optimum capital structure is a mix of debt plus equity, where the risk is shared with the debt and minimal effect is created on gain to the equity holders. This theory says there is no fixed formula or equation what we can justify as a perfect capital. A perfect capital is that situation when I have my own funds and borrowed funds equating together as maximum value for shareholders' capital. If I can give the dividend high, if I can maintain the equity, if I can reduce the risk, and the combination of that time, the debt and equity, it will be considered as the optimum capital structure. So, as per this theory, the marginal cost of involvement in debt, which narrates the minimized effect on equity benefits, is an optimum capital structure. So, debt or equity, the only answer is how much it contributes to wealth maximization. If it contributes well for the wealth maximization, then it is considered as excellent capital structure. If instead of contributing to capital structure, it just ensures to give away the earnings or profit, then we should not think about debt, we should think about equity. So as per this theory, these two ratios are most important. One, debt to capital ratio, and second, debt to enterprise value. According to this, the debt to equity ratio talks about how much is debt and equity, whereas debt to enterprise ratio talks about the change in firms or enterprise, its profitability due to the debt. If the value propositions are increasing, then we should have the borrowed capital and own capital. But if the value is reducing, we should not focus on borrowed capital. We should only think about the own capital. In industry, this theory is an response of trade-off. Now, the literal meaning of trade-off is finding a balance between two. So, this theory is a proposition to understand that we cannot just go with the equity or we just cannot go with the borrowed funds. This theory is proposed in 1973 by Alan Carus and Robert Lizens. And this theory was companies should aim for optimum capital depth and marginal gain. So my structure of capital should be of such a way that it should generate the maximum revenue. It should focus on maximum benefits and it should avoid a situation where my profit is not effective. It is something like that. If I have the source of finance and I'm using the source of finance, then source of finance should be such a way that it will help you for managing your business. It will help you to grow with your business, and certainly the value of your firm is maximized. The theory is more deliberately accepted as trade-off theory because this theory is creating an simple company's leverage ratio or an equation which talks about the safety and risk which the firms are taking. It advocates that if the firm want to grow and firm want to take an advantage, the combination of own capital and borrowed capital should be implicated. Only the one capital or only the a simple equation will not be solution for optimum capital. One who like to decide what is optimum capital should take the congruence of market shares, legalities, and should talk about how the firm's value can be maximized by using the combinations. So this is all about trade theory. Now there are 1 minute is left for the session, but unfortunately I have power cut. So just let's revise the MM approach and the trade-off theory. MM approach has three values. MM talks about the capital structure is independent of equity and debt combination. It talks about the value of firm is maximum when the returns are maximum. When you make the investors happy, equity or debt, the firm's value is more. So he first proposed how much is returns generated by equity. That is value of firm. The second proposition he talks about the debt plus equity ratio as the most important thing. And he introduced debt plus equity ratio as a relevant great factor to decide because the cost of borrowing for debt is important. In third propositions, he highlighted that the tax which is applied or used is also relevant. And then we've seen the combinations of three equations in WACC, in tax shield, and others. Then we discuss the trade-off theory. As per trade-off theory, the balancing between the equity and debt should be there, indicating the productivity and comfort of that industry and its financial need. The company or the organization should think about wealth maximization and minimize cost-effective trends for their recordings. So this is all about the theory of trade-off. If any doubt, please note down. We'll discuss in next session. Now you can log out and continue your journey of learning through online sessions. Wish you a wonderful day ahead. Thank you.